Silver, as it makes these all-time record highs, I think we could see $68 by the end of the year. I believe that silver, as hot as it's running, doesn't appear to show any signs of letting up. We could see higher prices as we go into the end of the year. With about 2 weeks left in the year, I would not be surprised for gold to challenge the all-time record closing price above 43.70. So it's not a huge stretch to see gold move another $60 in 2 weeks. Silver tends in terms of percentage gains to outperform gold.
It looks like gold and silver typically move together in tandem, with silver mostly outperforming gold during bull markets.
We're in uncharted territory in both gold and silver. A lot of it has to do with the dollar and dollar weakness, but I think it's a much more involved investor concept than that. Stocks have been doing well, but the asset class of the precious metals have been...
Gold is at $4,300 and silver is at 63.5, just retracing from its previous high of 64, over 64. And so these are unprecedented levels for silver, and gold is up 2% on the day. I wonder how much of this move is a reflection of what you just heard, Gary, that more money supply is about to hit the market.
I think for a large part, it is a reflection of comments made by Powell. While we were all expecting them to maintain current interest rates, the fact that they're adding to their liquidity base by huge purchases, $40 billion on a monthly basis, is something that came unexpectedly. And therefore, the reaction that we're seeing in both gold and silver, with silver moving to new all-time record highs and gold moving within somewhat striking distance of the record highs, about $60, $70 away. That was to be expected after we saw the comments by Chairman Powell. Absolutely. We weren't expecting it. We're seeing the precious metals react to it today as well as yesterday.
Okay, let's take a look at your chart. Let's jump straight into the charts, Gary, and get your updated outlook. So previously you had commented on, I think, $4,300 was your upper target. We're at that right now. So do you have an upgrade? Yeah.
This move looks explosive on the surface, but the real story is buried inside central bank balance sheets. What's quietly acknowledged here is that Powell's $40 billion per month liquidity expansion effectively overrides the higher for longer narrative investors were fed all year. As Gary Wagner hints, gold and silver aren't reacting emotionally. They're repricing currency dilution in real time. A 2% daily move in gold isn't speculative froth. Historically, that magnitude shows up when policy credibility cracks, like during 2020 QE or post-2008 easing. Precious metals are front-running monetary expansion, while equities still pretend rates are the only lever that matters. And when silver makes all-time highs before a formal rate cut, that's usually a signal, not noise. Next, Gary Wagner talks about targets, and more about how fast trust in policy erodes.
Basis the most active February futures contract. That's what we're looking at here. We're currently 43.10. My sentiment is, with about 2 weeks left in the year, I would not be surprised for gold to challenge the all-time record closing price above 43.70. And, now we're only about $60 away. So it's not a huge stretch to see gold move another $60 in 2 weeks. Could be much higher, considering that today alone, gold moved up about, $51 or 1.2%. So we could see that very achievable by the end of the year, or sooner, especially after today's huge breakout in both gold and silver.
Okay. Well, any potential headwinds that you're looking at on the horizon?
Obviously, as far as gold is concerned, the first level of any kind of technical resistance comes at the all-time record high, and that is roughly 43.70. It's different for silver because silver is at all-time record highs, and like gold, when gold was trading back in September, all the way up to October the 20th, when it hit the all-time record high, and closing price, it could easily catch back up to that. Silver's a different story because we're in uncharted territory, as we were in gold back in October as it ran to the record high.
A $60 move sounds small, but context matters. Gold has already absorbed a $50 daily gain without hesitation. Gary Wagner is pointing out something subtle. Momentum is accelerating into resistance instead of stalling, which is a typical late in a move. When gold approaches record highs while silver already clears them, historical sequencing suggests gold often follows, not reverses. In prior cycles, including 2011 and 2020, gold tested highs multiple times before any meaningful pullback occurred. The lack of nearby technical headwinds tells you positioning isn't crowded yet. Investors waiting for a clean pullback may find price discovery happens first. Next, Gary Wagner explains why silver complicates this picture even more.
I want to flip over to my chart and just take a look at silver versus gold. I don't want to talk about exclusively silver right now, but just to show a comparison here. It's one thing to have silver catch up to gold, as some analysts are saying that's what's happening right now, but it's another issue when silver is outperforming gold by orders of magnitude. When gold has been flat ever since October, if you take a look at October 17th to now, gold's actually down. So gold hasn't even retraced its previous all-time high yet. In the same period, since late October, silver's up 20%, gold's up 1%. So flat gold up 20% on silver. The notion that silver has usually lagged behind gold and plays catch up at a certain period, that hasn't always consistently been the case. If you just, I'm scrolling back here, and it just looks like, if this chart would allow me to do so, it looks like gold and silver typically move together in tandem, with silver mostly outperforming gold during bull markets. Again, last 2 years has been a little bit different with silver lagging, but from a technical perspective, you're looking at something that has typically moved together. And yet, at the same time, in the last 3 months, gold is up 18%, silver's up 50%.
This divergence isn't just interesting, it's structurally important for investors. Silver gaining 50% while gold is up 18% breaks the clean catch-up narrative many analysts default to. As Gary Wagner explains, silver normally outperforms during bull markets, but this speed suggests speculative capital is rotating aggressively, not cautiously. Historically, such silver outperformance often coincides with late cycle liquidity surges rather than early recoveries. That matters for portfolio risk, because silver drawdowns tend to be sharper when momentum flips. Investors treating silver as a safer version of gold are misreading history. The next section, Gary Wagner confronts whether this run is justified or already vulnerable.
Like you told me offline, it's a runaway train. How do you analyze these technicals? Do you look at silver and say, this has run up too far compared to its benchmark, gold? Or do you look at gold and say, it's time for gold to start playing catch up now, and gold looks relatively undervalued?
Well, what I can say is that we have typically seen both of them move in tandem. However, on moves up, silver tends in terms of percentage gains to outperform gold. Reciprocally, when they're in a corrective period, when they're moving to lower prices, the opposite is true. You get silver outperforming or having a greater drawdown in a percentage basis than you do gold. Now, we're still seeing that, but they have really uncoupled in terms of what we've seen recently, in which silver has just taken off and I believe is playing catch up to gold's move to the all-time record high. And that occurred quite some time ago, because that occurred during the last couple of weeks of October. And silver was relatively flat at that point in terms of gains. And then silver took off with a mind of its own, let's say. It definitely is outperforming gold in terms of percentage gains.
Calling this a runaway train sounds exciting, but it masks the asymmetric risk Gary is outlining. Silver's historical pattern is brutal. It outperforms on the way up and punishes faster on the way down. That's not opinion. It's been visible in every major metal cycle since the 1980s. What's unusual now is the decoupling, where silver is sprinting while gold hesitates below highs. That often happens when speculative flows front-run a broader move, or when excess liquidity looks for volatility. Investors chasing silver without acknowledging its downside behavior are ignoring the second half of the chart. And what Gary Wagner explains next directly addresses where that risk shows up first.
And now that it is at a new all-time record high, it becomes more difficult to peg where silver could go. We're making assumptions as to where it might go by the end of the year, where it might go next year. But these are assumptions because as a market technician, we have no data at how silver performed above $60. Simply put, it's never been here before. And so because of that, it makes it much more difficult to really predict where it would go. Although I do believe it's possible that we will see silver continue to move up. We could see it move really as high as 68. That's a tremendous push, but I believe that is within the possibility of probabilities by the end of the year. Gold is just trying to play catch up to the former all-time record high because it is below that now. And I believe that both gold can try to recapture the all-time record high. And I believe that silver, as hot as it's running, doesn't appear to show any signs of letting up. We could see higher prices as we go into the end of the year. There's still time left. We've got 20 days left in this year. So a lot could happen. And I believe that the precious metals as a complex will remain strong. They will not give up much of what they have captured. And I would not be surprised to see silver close out the year at an all-time record high above current pricing, and gold to recapture the all-time record high that it hit on the third week of October.
Silver breaking into price levels with no historical reference sounds bullish, but it also removes the safety net most traders rely on for risk modeling. As Gary Wagner points out, there is literally no prior data above $60, which means targets like $68 are probability estimates, not technical certainties. Historically, when assets enter price discovery, volatility expands before direction resolves, something silver has done repeatedly during past commodity supercycles. Gold lagging here matters too because leadership divergence often precedes consolidation phases. What matters next is whether liquidity keeps favoring metals into year-end positioning. And what Gary Wagner says next reframes why chasing strength blindly can be more dangerous than sitting tight.
Yeah.
We're in uncharted territory in both gold and silver when we look at a long-term chart. And because of that, it becomes difficult to predict the top because as a technician, I'm looking for what happened when it was trading at this area. In the case of gold, we can, because gold has roughly been here, but it has broken above on a monthly basis the all-time record, which was at 4,200. Now we're at 4,300. And if I would have been asked at the beginning of the year, what do you think about silver moving past 60 and gold moving past 4,300? I would ask, how much alcohol have you consumed? In other words, I would have thought that to be unrealistic. But lo and behold, that's what we're looking at, and that's the reality. A lot of it has to do with the dollar and dollar weakness, but I think it's a much more involved investor concept than that. Stocks have been doing well, but the asset class of the precious metals have been something that have moved up over time, but they're moving consistently higher.
The quiet admission here is that consensus models completely missed this move, and that should make investors cautious about who they trust next. Gold clearing $4,200 on a monthly basis is not just technical noise. It signals a structural shift away from dollar confidence, something the DXY weakening trend has reinforced since mid-year. But blaming this solely on dollar weakness oversimplifies the story. As Wagner hints, precious metals rising alongside strong equities contradicts the risk-on versus safe haven narrative Wall Street still pushes. That divergence usually shows stress building beneath headline optimism. What comes next challenges the idea that this rally is purely momentum driven.
They went parabolic, as I said, beginning in August of 2025 up to about October of 25, and then had a very, very minute correction. And the correction was really from 4,200 down to 3,900, so a couple of $100 after moving up from 3,300. So it gave back about 20% of the gains, and that was the last leg of this extended rally. Where is the limit? Where could gold go next year? It could go much higher than it is now. Where could it go this year? I believe that it will make a play for the all-time record intraday highs when you look at a monthly chart and intra-week closes.
Okay, a few more follow-up questions before we end the conversation now. Gary, I think that leads to the fundamental question that a lot of traders, especially retail traders who aren't already in the gold market, are asking themselves is, do I get in now? And, you don't have to give direct advice, but we can talk about risk management here from a trader's perspective.
Parabolic moves followed by shallow pullbacks often signal strong underlying demand, but they also compress future upside. A 20% retracement after a $1,000 run is historically mild. During prior gold bull markets, pullbacks of 30 to 40% were common before trend continuation. The real issue for retail investors isn't upside targets, it's entry timing and exposure size. Wagner's framing subtly shifts from price prediction to risk management, which is where most portfolios either survive or fail. Chasing intraday highs without a plan has historically produced regret, not returns. Next, Gary Wagner addresses the hardest question investors ask at market extremes.
Because like you said, maybe the upside here is more limited than it was 2 years ago. Certainly in retrospect, that is the case. We don't know where the top is. We don't know where the bottom is. Timing tops and bottoms is very difficult, if not impossible. And so how does one go about thinking about the question, do I go in now? Or is it already too late and I should just wait for a correction, not knowing when that may be, not knowing if that will ever come? So, missing out on future gains is in itself a kind of a loss when you think about it, because you're losing out on utility.
This has been a question I've been asked on multiple occasions over the last couple of weeks, to say the least, and my advice stays the same. For those who have been buying and accumulating physical gold or silver, they should continue to do so, but in terms of the ratio, their allocations per month or per quarter, they should either half it or take it down to 1/3.
This is where discipline replaces prediction, and most investors struggle to make that shift. Wagner acknowledges a hard truth. Upside asymmetry shrinks as prices rise, even if the trend remains intact. Dollar cost averaging with reduced allocation size reflects classic late cycle positioning. Participate without overexposure. Historically, metals bought aggressively near euphoric phases underperform for years, while steady accumulation outperforms emotionally timed entries. This advice quietly rejects the all-in mentality promoted by media headlines. It's not about catching tops, it's about surviving volatility without exiting at the worst moment. What follows explains why patience may outperform conviction from here.
I would continue to accumulate until the data shows us that we've hit a potential top in gold and silver. We haven't. And so I would say to accumulate in a much less aggressive manner, but continue to accumulate, because when we're at these levels, I don't want to say sky. It's not that the sky is a limit. There's going to be a top somewhere. It will correct somewhere. It has in the past. Could that change? Yes, but I think that's unlikely. There comes a point when any market is valued in an overbought scenario, and traders begin to either liquidate and pull profits or look for it on the short side. I don't think we're there in gold or silver, but I don't think it will continue to gain value forever without either consolidating or correcting. In the case of gold, we have seen it move up substantially higher, but as I said, it only corrected about $200 after moving $1,000 higher.
This is where discipline quietly matters more than conviction. As Gary Wagner outlines, the data still doesn't confirm a macro top, but he's also signaling something subtle. Risk management replaces bravado at elevated prices. Historically, gold bull markets rarely end without clear distribution signals, and a $200 pullback after a $1,000 run is statistically shallow by any long-term metric. For investors, this argues for position sizing, not abandonment. Accumulating slower protects capital while keeping exposure to an asset still supported by liquidity and policy drift. What comes next reframes how shallow corrections can mislead late buyers.
That's not a deep correction. A deep correction could be giving back 60%. In other words, if it moves from $1 to $2, of giving back on that dollar gain, 50 or 60 cents is still considered an acceptable correction on a technical basis in a bull market. And we're not seeing anything like that. As I said, we saw it give back $200 after moving up $1,000. And that's only a 20% retracement. That's extremely shallow. As a technician, we don't even chart that as a potential correction. We look at something much deeper, something along a 30% correction as being a level that it could go to. We haven't seen that in gold. Silver has just, as it makes these all-time record highs, until it trades lower, I think we could see $68 by the end of the year. And as I said, I know that that's a stretch, but it is in the realm of possibilities.
Here's the data disconnect most headlines ignore. Shallow pullbacks signal strength, not exhaustion. Wagner's reference to a 30% retracement aligns with classic bull market structure seen in gold cycles during the 1970s and post-2008 runs. A 20% pullback after a parabolic move is historically noise, not trend failure. For silver, price discovery above prior highs distorts traditional resistance analysis, making volatility appear reckless when it's structurally normal. Investors should read this less as a price target and more as confirmation that momentum hasn't structurally broken yet. Next, the focus shifts from charts to the forces that could finally reverse them.
Gold, I think that it could recapture the record high, and if it gets really bullish, look to test just below 4,400, which are the intra-week highs. This is a monthly chart, so an intra-month high, before having a sizable correction. It remains highly bullish, my sentiment, and I believe that gold and silver could consolidate at any moment, but I don't see a correction from here to the end of the year. Could be wrong, but that's at least what I believe.
Finally, Gary, now the macro forces we talked about are still supportive for gold. At what point could they flip? So going to 2026, what trends or trend reversals are you looking forward to that could flip the script and make you change your mind on the long-term bullish narrative? Certainly, we've talked about Fed monetary policy. We've talked about how loosening monetary policy and money supply expansion is bullish for gold, especially if the long end of the interest rate curve is coming down.
This is where optimism quietly collides with macro risk. Wagner's bullish framing rests heavily on liquidity conditions and yield suppression, not speculative demand. Historically, gold peaks only after monetary tightening becomes credible, not when easing is merely discussed. The real red flag isn't consolidation. It's a surprise reversal in long-end yields or a sudden Fed credibility shift. Until then, gold remains less a trade and more a referendum on policy durability heading into 2026. What he flags next explains why central banks may be the real market makers now.
But what could change?
Well, what I would look at additionally that we haven't brought up is the huge accumulation by central banks worldwide picking up physical gold. China being one of the biggest ones, that they are going on 13 consecutive months of accumulation, buying physical gold, hoarding it, putting it in their stockpile. Their central bank at least believes that in terms of strength of liquidity and strength of solvency in terms of the central bank, rather than dollars, gold is the preferred asset to have. because of the way that it maintains value, and it maintains value in relationship to the dollar in a much stronger way. As long as central banks are accumulating, I think the trend is going to be hard to see it correct hard because the central banks will buy those dips. China has 13 straight months of accumulation. That tells you something because they've got the ability to buy and hold, and they feel that that is the best asset to keep in their central bank. And so that speaks in spades to me because the central banks typically, in terms of asset accumulations, make fairly smart moves. If not, they're able to hold on to it if they're wrong, but they're not going to continue to add to a position when they believe that there's a possibility of a top. And as long as the central banks are accumulating, there is a possibility of both gold and silver, specifically gold, because that's what they're accumulating, to stay strong.
This is the quiet power shift markets rarely price correctly. 13 consecutive months of Chinese central bank accumulation isn't speculation. It's strategic balance sheet insurance. Historically, sustained central bank buying has coincided with multi-year revaluations, not short-term spikes, as seen from 2009 to 2011. Retail traders trade momentum, central banks trade regime change. As long as sovereign buyers absorb dips, downside volatility gets artificially capped, reshaping risk for both bulls and skeptics.